You want money, not vibes, not hustle quotes. Money, the kind that lets you upgrade your life. Better apartment, better food, fewer panic attacks when your car makes a weird noise. So you hear this advice: just invest in stocks. Cool. What does that even mean? Are you gambling? Is it just rich people passing money back and forth? Why do some people build real wealth while others lose everything? Today we're breaking down one thing: how stocks actually make you money. No hype, no crypto bro energy, just how the system works. And we're going to use one running example the whole time: your $5 coffee habit. Because yes, that matters more than you think. What is a stock? A stock is ownership. That's it. When you buy a stock, you're buying a small piece of a real company. Not a symbol, not a line on your app, a real business. If you buy shares of Apple Incorporated, you own a tiny slice of Apple. Apple sells phones. Phones make money. You own a slice of that money machine. It's not abstract. It's partial ownership. So when people say the stock market, they're really talking about a giant marketplace where ownership in companies gets bought and sold, like eBay, but for businesses. Okay, moving on. Why companies sell stock? Companies need money to build factories, hire engineers, launch new products, expand. Instead of borrowing all that money from banks, they can sell ownership to the public. They go public through something called an IPO, initial public offering. That's when regular people can start buying shares. In exchange for money now, the company gives up small pieces of ownership. Simple trade. You give them cash. They give you a claim on future profits. Now here's the important part. You only make money if that business does well. Not because the app says green numbers. Because the company actually earns money. Cool. Now let's talk about how you get paid. 2 ways you make money. There are 2 main ways stocks make you money: price increases, dividends. That's it. No secret third option. Let's break both down. Capital gains. This is the one everyone talks about. You buy a stock at $100. Later it's worth $150. You sell. You made $50. That profit is called a capital gain. But here's the real question. Why did it go up? Stocks don't randomly float upward forever. Over time, stock prices tend to reflect company performance, especially profits. If a company grows revenue, increases profit, launches successful products, or becomes more efficient, investors expect it to earn more money in the future. More expected profit equals more demand for ownership. More demand equals higher price. That's supply and demand. Basic economics. Now think about your $5 coffee. If you invest that $5 instead of spending it, and it grows over time, you're essentially turning caffeine into ownership. That's the game. Okay, but what about dividends? Dividends. Some companies share profits directly with shareholders. That payment is called a dividend. If a company earns money and decides to distribute part of it, you get paid just for owning the stock. It's like getting rent for owning part of a business. Not all companies pay dividends. Younger, fast-growing companies often reinvest profits instead of paying them out. More established companies are more likely to pay dividends. Dividends are real cash, not paper gains. And if you reinvest those dividends into more shares, that's when things get interesting. Which brings us to the most important concept in investing: compound growth. Compounding is when your returns start earning returns. You invest money, it grows. Then that growth also grows. It's financial snowball physics. If you invest your $5 coffee money consistently, say daily, and those investments earn returns over years, the growth isn't linear. It accelerates. This is not magic. It's math. Historically, broad U.S. stock market returns over long periods have averaged positive returns, though they fluctuate year to year. Not guaranteed, not smooth, but over long horizons, growth has happened. Time is the multiplier. Start early? Massive advantage. Start late? You're playing catch up. Okay, but this sounds too easy. Here's the catch. Volatility. Stocks move. A lot. Some days up, some days down, sometimes very down. This movement is called volatility. Volatility is normal. Short-term, prices react to news, earnings reports, economic data, interest rates, and investor emotion. Long-term, business performance matters more. But in the short term, humans panic. And panic is expensive. If you buy high because everyone's excited, then sell low because everyone's scared, you lock in losses. The market doesn't punish ignorance. It punishes impatience. Remember your $5 coffee? Imagine skipping coffee for a month, investing that money, and then selling everything 2 weeks later because the market dipped. You basically suffered caffeine withdrawal for nothing. Zoom out. Always zoom out. Ownership versus gambling. People say stocks are gambling. That's not accurate. Gambling has negative expected value. Casinos are mathematically built to win over time. Stocks represent ownership in productive businesses that create goods and services. Over long periods, productive economies tend to grow. Are there risks? Yes. Can companies fail? Absolutely. That's why diversification exists. Diversification means spreading your money across many companies instead of betting on one. If you only own one stock and it collapses, you're done. If you own hundreds through a broad market index fund, one failure barely matters. An index fund is a fund that tracks a whole market index, like the S&P 500. Instead of picking individual winners, you own the whole group. This reduces company-specific risk. It doesn't eliminate risk, but it smooths it. It's the difference between betting your entire future on one startup versus owning a slice of the whole economy. Most long-term investors use diversified funds for this reason. Boring? Yes. Effective? Often. Why prices move daily? Daily stock movements are driven by expectations. Not just current profits, future expected profits. If investors believe a company will grow faster than expected, price rises. If growth looks weaker than expected, price falls. It's not about good or bad. It's about better or worse than expected. That's why earnings reports matter. If a company reports strong earnings, but investors expect it even stronger, price can drop. Markets are forward-looking. Think of it like pre-order hype for a new phone. Expectations drive behavior. Long-term versus short-term. Short-term trading is unpredictable. Professional traders compete with advanced tools, algorithms, and deep research teams. Trying to outtrade them casually is ambitious. Long-term investing is different. Instead of predicting next week, you focus on long-term business growth. Time reduces the impact of short-term noise. Historically, longer holding periods have reduced the chance of losing money in diversified stock portfolios. Not eliminated, reduced. There are no guarantees, but time shifts probabilities. Risk and return. Higher potential return usually comes with higher risk. Safe assets like savings accounts generally offer lower returns. Stocks offer higher potential returns with higher volatility. This trade-off is fundamental. If something promises high return with zero risk, it's either misunderstood or a scam. There's no free lunch in finance. Even your $5 coffee costs something. Opportunity cost. If you spend it today, you don't invest it. Every dollar has options. The role of time. Time is more powerful than intensity. You don't need to perfectly time the market. You need consistency. Investing regularly over time, regardless of short-term ups and downs, is a strategy many long-term investors use. It reduces emotional decision-making. It builds discipline. And it turns your coffee habit into a future asset machine. Miss a few days? Fine. Quit entirely because of a bad month? That's expensive. Taxes. When you sell a stock for profit, you may owe capital gains tax. In many tax systems, long-term gains, holding over a year, are taxed differently than short-term gains. Dividends can also be taxable. Taxes reduce net returns. So strategy matters. Tax-advantaged accounts exist in many countries to encourage long-term investing. The rules vary by country. But ignoring taxes is like ignoring gravity. It's always there. Inflation. Inflation reduces purchasing power over time. If prices rise and your money sits idle, your real buying power can shrink. Investing is one way people attempt to grow money faster than inflation over long periods. Not guaranteed, but historically, equities have outpaced inflation over long stretches. Your $5 coffee today might cost more in 10 years. But if that $5 had been invested and grown, different story. The emotional game. Investing is simple. Humans are not. Greed pushes people to chase hype. Fear pushes people to sell at bottoms. The hardest part isn't math. It's behavior. The market rewards patience and discipline more than excitement. You don't need to check prices daily. Businesses don't change value minute to minute just because your app refreshes. Calm beats clever. Realistic expectations. Stocks are not a get-rich-quick scheme. They are a get-rich-slowly if you're consistent system. Some years are great. Some years are ugly. Over long periods, diversified equity investing has historically rewarded patience. But again, no guarantees. The system works over decades, not weeks. Which brings us back to the coffee. The coffee test. Let's say you spend $5 per day on coffee. That's $35 a week. About $150 a month. Over years, that adds up. If instead you invested that consistently in a diversified fund and let it grow, the difference compounds. Not because coffee is evil, but because small recurring amounts matter over time. Investing isn't about massive one-time deposits. It's about consistency. Habit scale. Rapid recap. A stock is ownership in a company. Companies sell shares to raise money. You make money through price growth and dividends. Prices reflect expected future profits. Volatility is normal. Diversification reduces company-specific risk. Time reduces the impact of short-term noise. Higher returns come with higher risk. Taxes matter. Inflation matters. Behavior matters more than intelligence. Consistency beats timing. Final takeaway. Stocks make you money when businesses grow and you stay invested long enough for that growth to compound. It's not gambling. It's ownership plus patience. Your $5 coffee today is comfort. Your invested $5 is future ownership. Choose intentionally. If this clarified how investing actually works, hit like, subscribe, and maybe consider investing before your next caffeine run. Or at least think about it while you're holding the cup.